Welcome to Accounting 201 Financial Accounting at Kapi'olani Community College. In this video, we'll look over the instructor notes for Chapter 1 of our textbook. First thing to notice is that accounting is a process. We identify, measure, record, and communicate the impact of business transactions or events. There are two major types of users of accounting information: internal users. Those include stockholders, managers, and other interested stakeholders who are permitted access. And external users. Those are users such as taxing authorities, banks, and other lenders, suppliers who grant us credit, and other parties. We use accounts to classify the impact of financial transactions and events on our company. We have two major kinds of accounts: permanent or balance sheet accounts and temporary accounts. Balance sheet accounts consist of the most important type, assets. Assets are economic resources that the business owns that are going to be useful in the future. So they have to be owned by the business and they have to be of some benefit in the future. Liabilities are simply debts of the business or amounts that we owe. Stockholders' equity is an unusual concept for most students to grasp. The basic idea is that it's the difference between our assets and liabilities, and various things have an impact directly upon it. Stockholders' equity represents the stockholders or the owners of the business interest in that business. If we were a proprietorship, we would call it capital, and it would include essentially the same kinds of elements. The things that have impact on stockholders' equity are any dividends we pay to our stockholders as a reward for being a stockholder, amounts we receive from issuing stock, and any net income or net losses that we have for a particular year, which will be explained in a little while. This stockholders' equity, when it's presented, is subdivided into two parts: the part that the stockholders paid to purchase their interest, which is known as common stock or paid in capital, and the part that the corporation grew by earnings. And this has to be the earnings that it hasn't given out yet to stockholders. Thus it's called retained earnings. So we can string these accounts together to form what's known as the balance sheet equation. And that says that assets is equal to liabilities plus stockholders' equity. However, an important reordering of this equation emphasizes the rights of creditors over stockholders. For a company to be able to borrow money, there has to be some assurance to the parties providing the funds to the business that their rights to repayment will be protected by the law. And so it works out that assets minus liabilities is what's equal to stockholders' equity. That's what's known as residual equity, meaning first creditors must be paid, and then if there's anything left over, that is the property of stockholders. This is in the event, for example, of a liquidation or a closing of the business. There are other kinds of accounts we're using, known as temporary accounts. Temporary accounts consist of three major types. Two of them are connected together on the income statement, and one of them goes on the retained earnings statement. The income statement accounts are revenues. Revenues is the price that we charged our customers or clients for services we rendered or goods that we've sold, and we always record them when they're earned. So revenues sounds like something good, right? There should be some positive side effects from revenues, and there are. Either our assets will increase or our liabilities will decrease every time we generate revenue. How do we generate revenue? Not by increasing assets or decreasing liabilities, but by providing services or products to our customers or clients. Expenses, on the other hand, are the cost of goods or services that we've used up while we're trying to earn revenue. And those get recorded when they're incurred, which is a fancy way of saying when we make them happen. So you would think expenses are probably not things you really want. And that's true in that when you have more expenses, either assets goes down or liabilities go up. When you put both of these two accounts together, you can compute what's known as net income or net loss, and that's what shows up on a company's income statement. Now, the book goes into a great deal of detail about telling you why revenues and expenses are part of stockholders' equity, as if they had an immediate impact on stockholders' equity. However, they don't. They're separately maintained for the whole accounting period, and then at the end of the accounting period, we kind of consolidate them together, and they have an impact then on our retained earnings. Dividends is the third kind of temporary account, and this is actually a subtype of stockholders' equity. It really represents amounts that we're distributing from our business to our stockholders, and uh, so thus it's kind of like a distribution of our earnings, but there's really nothing in retained earnings, so we're really typically distributing some kind of asset and saying that it came from our earnings. When you string all of these types of accounts together, the first kind of financial statement you'll want to create from them is the income statement. Income statement equation is very simple. It just says that revenues minus expenses equals net income. And it tells us for a specific period of time how much income we've earned. The retained earnings statement is next in line for preparation. Retained earnings statement starts out with our beginning retained earnings from a preceding period, and we add net income or subtract net loss if we've had a net loss, subtract any dividends, and we'll get ending retained earnings. So this tells us the things that had an impact on retained earnings for a specific period of time. The balance sheet equation puts together assets, liabilities, and stockholders' equity, and we've previously seen that. So you can see that the income statement produces net income that gets used on the retained earnings statement, and it produces ending retained earnings that gets used on the company's balance sheet as a part of ending stockholders' equity. So your balance sheet is going to be the final financial statement that we'll prepare in Accounting 201. A fourth statement, known as the statement of cash flows, is discussed at the tail end of Accounting 201. So putting all of these account types together, they string together like this. We have assets, and they're equal to whatever liabilities we use to finance them, plus whatever stockholders' equity we've generated by issuing stock or the earnings process in the past, minus any dividends we've declared and distributed, plus any revenue we currently have, and minus any expenses we currently have. You can rearrange these in an easier to remember form by just adding the negative amounts on the right side here to both. And so we'll end up with assets plus drawings plus dividends plus expenses equals liabilities plus stockholders' equity plus revenue. So that kind of is a form that's helpful for when we get into Chapter 2 and discuss what's known as the debit and credit rules. Last few items here are some theoretical background. When we're talking about business transactions or events, we're looking at those things that had an effect on the company's assets or liabilities. So this means anytime you record a business transaction or event, you have to ask yourself, has it had any impact on our assets or liabilities? If the answer is yes, then there's something to be recorded. If the answer is no, typically there is nothing to be recorded. Next, when you select accounts, you kind of look for accounts that seem to have some kind of relationship to what's being described in the transaction description. And there'll be at least two accounts. And remember, at least one of them will have to be an asset or a liability. Both could be involved, but you will not have any transactions with neither involved. Once you've selected the two or more accounts that are impacted, then you need to decide whether the accounts are getting bigger or smaller. Don't let your impression about whether an account is an account you like or an account you don't like get in the way. For example, if we charge something on account, a purchase for example, then we owe more money and I'm not so happy that I owe more money, so I'll put that down as something negative. No, it's not. It's positive that you owe additional amounts, so the liability gets larger rather than being a negative item. Last couple things here. GAAP, or generally accepted accounting principles, things that guide the way we do accounting. One of them is that we use the cost principle. So absent any other guidance to the contrary, we record transactions based on the costs involved, unless the cost can't be determined, and then we use what's known as fair market value as a substitute. This is in line with the principle of objectivity, where accountants like to be as objective as possible in their recording and reporting. The fair value principle says that if we have items for which the value fluctuates a lot and it's actively traded and we can determine its dollar value at any balance sheet date, then we should be recording that thing at its fair value. We'll get into that in chapter 12. And some assumptions we make. We assume that the operations of the business can be segregated from those of its owner. We also assume that everything can be expressed in dollar or currency terms, and that those items will be included in our records. And so, for example, a company that says our most important asset is our employees can't actually record the fact that their employees are an important benefit to them, because the employees have quote unquote no dollar value. The going concern assumption, not something in chapter 1, but something that could be of concern to some businesses if they're in bad shape. This says that we assume most businesses will continue to operate indefinitely. If, however, it comes to our attention that there is some question as to the company's ability to operate into the future, then as an external accountant expressing an opinion about that company, we would need to say that we have doubts about their ability to continue in operation. However, absent those kinds of concerns, we value everything based on the assumption that it will continue to operate indefinitely, not on a last-minute garage sale Craigslist value, but rather on cost or on the fair value principle when applicable. Okay, thanks for listening. Hope this helped.